A new consumer report released just this morning shows inflation in the U.S. picked up again last month, as high as 2.9%. Gas prices also rose sharply. Joining us now and every Wednesday, financial expert Chuck Zodda, the managing partner and the chief investment officer of Armstrong Advisory Group. Chuck, thanks for being with us this morning.
Good morning. Great to join you.
What does this latest inflation report do to the Federal Reserve's rate cut decision making?
So this report, even though it was higher than we'd like to see, it was actually better than the market was anticipating. The market was expecting the numbers to come in a little bit worse. So what we're seeing as a result of this is the projection that maybe we end up with one extra rate cut this year. At the time before this, markets were only expecting one rate cut over the course of 2025, now potentially pricing in a second one. But this obviously is very much in flux, and we still have, quite a bit of uncertainty as we go through the next 6 to 9 months here to try to sort through exactly what the inflation and growth picture is going to look like. But this report this morning, again, even though not what we'd like to see in a perfect world, was still better than what we're expecting heading in. And so I think that's something that has markets moving in a way that is largely towards a more accommodative Federal Reserve, where potentially we see some more rate cuts if we continue to see some improvement in the data.
Okay, well, the new year seems to have brought, a lot of uncertainty to the markets, as you were mentioning. Are we just kind of in a holding pattern, do you think, until at least Inauguration Day?
It's been the pattern over the last 8 weeks or so since the election. The S&P 500 has basically traded within a 5 percentage point range during that time, not really being able to break out to either the upside or downside. And I think a big part of this is we still don't know exactly what the policies are that are going to be enacted by the Trump administration in areas such as tariffs, in areas that might affect the labor market, such as potential deportations and things like that. And so I think it's really hard to get a handle on what the economy is going to look like until we have some concrete ideas about what policies are going to be put in place by the incoming administration.
Chuck, Mark Zuckerberg, Elon Musk, Jeff Bezos, they all plan on attending the inauguration. Do you see tech dominating again this year, or could some smaller companies make a move?
Well, here's the interesting thing is for basically all of 2023 and then the first half of 2024, tech companies, as you mentioned, were really kind of the dominant players in markets. It's been a combination of AI and other, themes that have really been driving that. But the second half of last year, we saw that falter a little bit, and tech was actually not the strongest area of the market in the second half of last year. So I think this comes back to something that we see quite often, which is oftentimes the sectors that might lead a market for 1, 2, or even 3 years at a time, they have a hard time sustaining that simply because you can't keep up those types of growth rates, for forever. It's just not something that's possible. So I think that there's a chance that you see tech continue, to maintain a leadership role in markets. But I do think we have to be open to the idea that, hey, even though it's what has worked for the last couple of years, by and large, it might not be what works going forward. And it's not because there's anything wrong with those companies. It's just really hard to sustain consistent outperformance in any area of the market.
The Trump tariffs are, of course, at play as he takes office. A lot of hype around those. There was some rumblings about the president-elect easing them to begin his term. How big of a role do you think these tariffs will play?
Well, I think they're going to play an absolutely huge role, and I don't know what form they are going to necessarily take still, but I look at what the president has said over time and his insistence that this is going to be part of what he does. I look at the people that he is looking to add into his staff pending confirmation hearings over the next couple of weeks, and they are talking about using tariffs in a number of different ways. And so I very much do believe that we have to believe the incoming administration when they say, hey, this is something that we are going to do. Exactly what form it takes, will it be, a significant jump in tariff rates right at the outset on January 20th? That's a possibility. Could it be something that's a more gradual increase of a few percentage points a month? That's something else that's been floated over the last couple of weeks. And so I think there are a number of different paths that this can take, but I do think this is going to be something that is central to the incoming administration, and that we have to believe is going to be implemented simply because they're talking about it so consistently. And this is something that a number of the president's advisors have talked about as being really important to them and how they want to try to shape the world going forward.
At the end of this month, we have another Fed meeting to discuss monetary policy. What are you expecting from this meeting, and then how could it affect the markets?
Yeah, the expectations are actually that this one's going to be pretty boring, which is not necessarily a bad thing. The Fed funds futures market is pricing in a 97% chance that there is no change in the Fed funds rate after the January 29th meeting. So right now, expected to be pretty boring. And I think part of this is we've had some conflicting economic data the last few months in terms of how quickly the economy is growing. So the Fed wants to kind of pause things and say, hey, let's take stock of where things are going. But you also have a new incoming administration, as we discussed, and I think they want to see exactly what policies are put in place so that they can decide what the appropriate response will be from the Federal Reserve, depending on how those policies from the incoming administration affect things like inflation or growth. So overall, January meeting probably going to be pretty boring, but the ones after that come, I believe it's going to be in March and then in May. Those have the potential for some significant changes depending on how the rest of the winter and early spring develop.
Okay, let's talk about the housing market really quick. Mortgage rates, they're back up near 7%. Is there any hope at all that we'll get back down below 6%, or do you think buyers are just kind of getting used to these rates?
I think, unfortunately, at least in kind of the short term, which I'll define as the next, 12 to 18 months, the only chance that we see mortgage rates on average nationally back below 6% is if the U.S. economy starts to look like it's heading into recession, and the Federal Reserve likely needs to cut interest rates much more meaningfully than is currently projected. So I think rates probably spend a lot of time hanging out in the 6s and 7s over the next year to year and a half. There is the potential, depending on how inflation moves in response to any tariff plans, you might even see rates potentially get up towards the 8% level if things go badly. I don't think that's my base case and what I would expect, in every situation. But I think there's a possibility that rates could move higher than where they are now, and we need to be prepared for that potential possibility as well.
All right, Chuck Zodda of the Armstrong Advisory Group. Thank you so much for chatting with us.
All right, have a good one.